Madam Secretary, I have concerns about the signs of volatility at the New York Community Bank. New York Community Bank is the largest multifamily portfolio lender in New York City with more than $37 billion in multifamily loans. By way of contrast, Signature had far less, $15 billion in multifamily loans. And so a crisis at New York Community Bank would not only destabilize the banking system, it would destabilize the largest multifamily housing market in the United States. Do you share these concerns, and how closely are you monitoring the situation at New York Community Bank?
Well, we are in touch with supervisors, and we are monitoring current banking stresses carefully. I don't want to comment on the situation of an individual bank, but, you know, commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system. And this is something that requires careful supervisory attention.
And so is it fair to say that you, as Treasury Secretary, that you're prepared to do whatever is necessary to prevent a second wave of bank failures?
Well, I don't want to get ahead of where we should be given what's happening. And I don't want to comment on the individual situation here, but you know, as Treasury Secretary, I would work with the banking supervisors to make sure that we addressed anything that looked like it could create systemic risk.
There's been considerable reporting about the rise of private credit. I'm wondering if we are seeing in the American financial system the paradox of more regulation having the unintended consequence of causing less regulation. So specifically, to what extent has the intensive regulation of banking in America led to the emergence of a largely deregulated shadow banking system?
Well, I mean, that naturally happens when one carves out an area to regulate that there's an attempt to move activity outside that regulatory system, and perhaps private credit is an example of that.
So if that is true, to what extent will Basel III accelerate that trend?
Well, it's conceivable that it could, but it's also, it's important, and FSOC in part exists to make sure that we're looking not only at banks, but
are we managing risk, or are we transferring risk?
We're making sure that there's adequate regulation to address risks that could have spillovers that threaten economic performance and the entire financial system.
The PWG report proposes something resembling banking regulation for stablecoin issuers. Unlike a bank, a stablecoin issuer has no lending and no fractional reserves. And so if a stablecoin issuer operates differently from a bank, why not regulate it differently from a bank?
Well, perhaps it should be regulated differently from a bank, but nevertheless, it's necessary to regulate the risks to make sure that the deposits are channeled into safe assets. You know, perhaps the capital standard should be different, and you know, other features of its regulation should be appropriate and different. It's something more like a narrow bank, but that it should be regulated because it inherently has run risk, very similar to banking organizations.
The single greatest powder keg in the world is the Taiwan Strait, where a PRC invasion of Taiwan or a blockade could conceivably cause the gravest global catastrophe since World War II. According to Bloomberg Economics, the cost of a war over Taiwan would cost $10 trillion, 10% of global GDP. It would exceed the cost of the global financial crisis and the global pandemic. Does the Treasury Department conduct economic and financial simulations or war games to determine the impacts of a possible conflict and determine what actions that we as a country should take in advance to mitigate those impacts?
Well, the National Security Council and the interagency, I don't want to detail steps that they've taken, but certainly the risks from the Taiwan Strait have commanded their attention and preparation.
Thank you.